Hello, and welcome back to the video series on KPIs and financial metrics. This is the second video in the two-part series on the topic. These two videos, as well as other content from the Finance Library, are available on our site at www.finance-library.com and also on our YouTube channel at finance-library. So this is part two in the two-part video series, as I mentioned. And in the series, we are building a framework for measuring and communicating financial value, especially for non-revenue functions. In the previous video, we talked about identifying metrics and linking activity-based KPIs to financial metrics. And we approached that linking of the translation using a method we call the three-stage method. We also discussed how to use benchmarking as a way to leverage the efforts that you put into KPI tracking and how to leverage that when it comes time for a budget proposal. In this second video, this is the current video, we are going to focus on the nature of KPIs and how to bring together what we have learned so far to manage KPIs better. We'll start with predictive KPIs. As you know, most KPIs track performance based on realized outcomes. So that's why they're called lagging indicators. They tell you what has happened. And these lagging indicators are typically updated as data becomes available. In contrast, leading indicators tell you what's coming. Where leading indicators are helpful is in showing the financial consequence of inaction. You may remember from the discussion on budget proposals, we talked about presenting the cost of inaction as one of the factors to persuade the finance team to support your proposal. So these leading indicators can fit in very nicely into that theme. Because you can use these leading indicators very powerfully to win budget approval for what you would call preventive investments, right? Investments that often get sidelined or pushed back because they are not high priority or don't appear as high priority in the moment. And by using these leading indicators, you can make the case for preventive investments by showing the financial consequence of inaction well before the problem hits the P&L. Okay? So now let's look at some of the examples of leading indicators and contrast them with lagging indicators. Okay? So if you think about lagging indicators, the scoreboards that we typically use with, financially, we might say, what was the revenue last quarter? And from a HR perspective, we might talk about the attrition rate that is currently being reported, right? So the attrition rate from last year or last quarter. We might quote defect rates this month. We might quote customer churn over a certain window of interest. Now, all of these tell you the outcome, and it is still useful because both to you and to the finance team to evaluate past decision and hold the team accountable. You might be able to use this to hold your team members accountable. Finance may in turn be able to use this to hold you accountable. Okay? So it's not that lagging indicators are not useful. They're useful in a particular way. Where when we look at leading indicators, we're looking for indicators that can predict how things might turn out 6 months from now, 3 months from now, and so on. So for instance, if you're looking at if you want to predict attrition, you might want to look at employee engagement scores because they might help predict attrition 6 to 12 months out. Or if you're looking at pipeline coverage, that is the amount of opportunities you have in place relative to the revenue targets you have set. If you see the pipeline coverage as weak, that tends to predict revenue shortfalls. Or if you are in manufacturing, the first pass yield trend, meaning the percentage of products that pass the process the first time without requiring, say, rework or repair. That would be a good indicator of what future defect costs might look like. Or from a marketing standpoint, you might look at the net promoter score. For those of you who are unfamiliar with that, it is the percentage of favorable customers relative to the percentage of detractors. When the percentage of detractors, when this ratio is low, it tends to predict churn and long-term customer value erosion. Again, from an HR perspective, we might look at time to fill a position trend. So the number of days it takes from a job being approved to a candidate's acceptance of the offer. That if it is long, that might be helpful in predicting hiring cost pressure. Right? So you can see that the leading indicators too are KPIs. It's just that they have a forward-looking aspect to them, which when combined with lagging indicators can be very helpful in both for you in terms of you understanding your business, your functions, but also in interacting with the finance team. Okay, so now that we have talked about the various nuances of KPIs in this video, now with leading and lagging indicators and all of the other considerations we looked at in the previous video, such as activity versus financial KPIs, benchmarking, and so on, we are now going to talk a little bit about how we can bring all of what we learned together in a way that is helpful to you. And this is often done through what's called a financial dashboard. Essentially, the financial dashboard is nothing but a one-page financial story. And the job of the financial dashboard, especially for a non-revenue function, is to help you prepare for the finance team's questions before they ask it. So what should be in the financial dashboard? I recommend 5 sections. And each of it will have various KPIs, and some of it will, depending on the availability of data, may be updated more frequently than others. Some of it may be updated weekly, others monthly, others quarterly. But the fact is you have as up-to-date information on the dashboard as possible at any given time. And the goal here is not to use it only once a year just before the budget time, but to use it all around, both to manage your function and to be seen as a credible partner to the finance function. So let's look at the 5 things that you should ideally see in a financial dashboard. I've listed all of it here on this page. And then what I'll do is I'll go through each of them one by one in more detail in the coming slides. So the first item here is the function cost summary. It's a summary of all the costs that you as a function incur. You want to be able to look at the total spend you are incurring versus budget, and also the trend of your expenses as the months go by, and also track it as a percentage of revenue, cost as a percentage of revenue, because that is a metric that the finance team will be tracking whether you want them to or not. The next item is more to do with lagging indicators. You're looking at 2 or 3 outcomes which are lagging indicators, which describe the value that you have delivered so far. It's important that you present them in dollar terms, not in activity terms. Number 3 is the leading indicators. These, like we discussed a minute ago, this is the predictive metrics that show where things are going and convey to the finance team that you are not managing the past, you are managing forward. Number 4 is the benchmark comparison. Like I said, it's very helpful in making the case for the cost of inaction. So tracking your metrics versus an industry benchmark, and then documenting the dollar gap can be very powerful. So I highly recommend having a benchmark comparison built into your dashboard. And then finally, measuring the ROI on your investments, the same ROIs you presented in your pitch for budgets. You can track them what you forecasted for that investment, what the actual returns being realized are for each of those approved investments. So let's start with each of these items. Let's go through each of these items, and let's start with the function cost summary. So the cost summary is your opportunity to lead the conversation and not react to comments from the finance team. It's your chance to look at the total cost, make sure you understand each element, and present it in a way that's favorable to you. Because if you don't, you can be sure somebody else will frame it, and chances are that they may not frame it as favorably as you. So, like I indicated in the prior page, you're going to track the trend in your cost incurred, and so consider presenting a trend line of these costs. In an ideal world, flat or declining cost as a percentage of revenue will signal that your function is scaling efficiently. But even if it is not, it gives you a sense of where things are heading, and not only in terms of the current year, but it tells you if your costs are remaining the same but revenue is declining, that you may have to be ready for pushback on next year's budget or next quarter's spend. So what should you include in the function cost summary? You should consider including the total headcount cost, salaries, benefits on a fully loaded basis. You should consider all the operating expenses of the tools and the services you use, as well as overhead. You should present any capital expenditures that you need, any active investments that you have ongoing. Very important also to present how you're doing relative to prior period. Not only to prior period, but also to the budget you have approved. So are you tracking well? Are you exceeding approved budgets? If you're exceeding, there's nothing wrong in being able to identify that excess, especially if you understand why, and maybe there is a case for additional funds to be approved mid-period, depending on the circumstances. So very important to know that variance and to own it. And then finally, just as a matter of tying your function to the rest of the business, do track these costs as a percentage of revenue. So those are some of the items you typically would see in a finance cost summary. Now, turning to the lagging indicators, that is the value that you have already delivered. This is an area that I find that functional leaders underinvest their effort. All you need to do is to present 2 or 3 outcomes with dollar proxies. And you can use the 3-layer method that we discussed in the last video to do that. You have the method now, you use it and use it every reporting cycle. Just to be clear what I mean by this, let's look at each of these items. When you say cost savings realized, what you're looking for is a way to quantify the reduction in spend relative to the prior period or relative to a baseline. So for example, you might say something like, we reduce cost per hire by $1,200 per hire times 80 hires equals $96,000 saved. That might be one way to document and quantify the cost savings realized from a certain action. Or it might show up in the form of efficiency gains. So for instance, hours recovered times their fully loaded hourly rate. For example, you might say something like process automation. The automation of processes that were otherwise done manually helped us recover 1,200 hours per quarter, and at $65 per hour, fully loaded, that led to a $78,000 improvement in productivity. Or in other contexts, it might be a question of reduced risk. So you're avoiding the expected value of the risk. So if, for instance, something you did like training or some greater engagement from employees led to a reduction in attrition, let's say it fell 3 points versus prior year, you look at the 3 points in attrition, convert that using the dollar proxy method, 3-stage method. And then you might say something like attrition fell 3 points versus prior year, which translated to $1.1 million in replacement costs being avoided. So that's an example of the kinds of indicators you might present in the lagging indicators. When it comes to leading indicators, you are starting to look at metrics like engagement score trends, net promoter scores, or first pass yield, time to fill trend, and so on, right? Um, so one of the things you might want to do is to include 2 or 3 metrics that predict future financial performance. By including it, it signals to the finance team that you're managing your function very proactively, not just reporting what has already happened. For instance, a declining engagement score can be used as a leading indicator of attrition in the next quarter, next few quarters, or even a year, and it gives you a chance to report that anticipated effect now before the cost actually materializes. And believe me, the finance teams are very appreciative of indications, heads ups that they can have about costs coming down the pike, into which they have little or no direct visibility. Another indicator might be the net promoter score, where if you see a declining net promoter score, that could be an indicator of a revenue forecast problem before it shows up in the actuals. Similarly, declining yield in a first pass might predict future defect costs, and rising time to fill indicates that there is hiring cost pressure and capability gaps that may be occurring without anybody actually noticing it. Now, one thing I'll say here is that in some of these things, you're going to get not so good news. So I fully recognize that you don't have, it's not necessarily thrilling to be the one delivering unfavorable news. But when that unfavorable news is coming from KPIs that you can point to and justify, and if you are doing it in the mix of things, where you're delivering some good news and some not so good news, that ability to deliver the not so great news because you are anticipating issues is really, really powerful in helping you build credibility with the finance team and being perceived as a true business partner to the organization. So now we move on to the next item, the fourth item on the list, which is the benchmark comparison. Because benchmarks, like I've said before, is one of the most persuasive data point in a budget conversation, you should use it as much as you can to reframe the discussion from, a simple request to a very justified request, right? Reframe it from, hey, the risk, nice to do, to absolutely things you have to do because of the inaction causes certain risks. So you're now able to document it very directly using third-party data. So by comparing a key metric against the published industry benchmark, you are able to tie an internal opinion that you may have to an external standard. And in the process, make the dollar value, the dollar cost of the gap very explicit. And when you present your metric, oops, I meant to change the slide here. Be precise and be careful to make sure that the definition you're using for your metrics aligns well with the way that same measure is computed on the benchmark, because otherwise the comparison may not be reliable. Right? And also with respect to the benchmark, wherever possible, cite the published benchmark and its source. It might be third-party publications like Gartner. It might be the Society of Human Resource Managers. It could be various institutes and third-party market analysts who are tracking this. And by naming those sources, you can increase your credibility and defensibility of your analysis. And sometimes you don't have it, then you rely on historical trends and historical data that you may have, your historical experience to set the benchmark. But always, always remember to convert the performance gap into a dollar value. This is a number that the finance team wants. It also becomes the ROI case for any investment that you are requesting to close the gap. Now that you have set up the benchmarking, you can now focus on presenting the ROI on ongoing active initiatives, right? Remember that uh, when you submitted your proposals, uh, presented an ROI number, and what you're doing now is for each investment approved in the large budget cycle, you're going to compare the actuals to date to the forecast that you presented in your proposal. This kind of a presentation does double duty. It demonstrates accountability for past approvals, and also it helps you build the credibility toward and build some goodwill towards the next budget year's request, and making it hopefully easier for the finance team to approve. So for instance, the dashboard might look something like this. You invested $210,000 in the management development program based on last year's proposal. You forecast that as a result, you would get $3.9 million in returns from lower attrition. Now that you're 6 months into the fiscal year, you're seeing $2.1 million in actual savings from attrition relative to averages. So you can now add a note to the finance teams that you're on track. You are expected to realize or perhaps even beat the ROI estimate that you forecast when you submitted the proposal. Similarly, for an infrastructure upgrade, so you asked for an investment of $450,000. You promised $2.3 million in savings from lower downtime. Perhaps you're 1 quarter in and you are now about $900,000 in returns, but you're only in the first quarter, so chances are that you will exceed by a good measure the forecasted return of 2.3 million. You could also look at it from the perspective of process automation, where you asked for an investment of $85,000, expecting $312,000 in returns because of efficiency. In the first 2 quarters, you are almost halfway there, so clearly you are on track to achieve the return. Now, I would ask you to pay particular attention to the variance explanation column. In my opinion, this is super critical. Every finance team knows that the actuals will almost always deviate from forecast. If it aligns, it's more coincidence than anything else, right? It's not that they don't expect surprises. They just don't want surprises without an explanation. So keeping them abreast of how the variances are playing out, and even when they're not playing out the way you expected it, keeping them apprised with an honest note allows you to maintain trust over the budget cycle. So now let me talk a little bit about the common mistakes I've seen in dashboards. A very, very common mistake, and one that we have discussed a fair bit in the video so far, is that of reporting activity, not outcomes. I've seen over and over again statements like we ran 14 campaigns, delivered 600 hours of training, or resolved 1,200 tickets, when in fact, you should be saying our campaigns reduced cost of customer acquisition by 18%. Our training reduced regrettable attrition by 2 points, which resulted in $340K in avoided replacement cost. So rather than focus on activity, when we use a second statement, we are focused on outcomes. Another mistake I often see is presenting numbers without methodology. The statements, when badly written, would look like our program saved us 2 million. And in fact, in an ideal world, you should say something like engagement improved 8 points, and using the Society of HR Managers benchmark of 1.5 times cost of replacement at our 15%, 1.5 times salary as a cost of replacement as a benchmark, and a 15% attrition reduction. That's a $1.7 million in replacement costs that was avoided. So here we are presenting the analysis and the methodology, but also stating the source. The third thing, which I find a lot of executives prone to do, in all honesty, I have tried to do this regrettably in my career as well, which is to hide unfavorable metrics. And the challenge with that is it has the potential to destroy trust because it's my experience, finance will find it one way or the other. And so you're better off saying attrition is at 18% versus the 12% that we expected, leading to a $1.7 million exposure. Here is our remediation plan and timeline. Okay? That's a much better way to handle it than to avoid reporting it altogether. So a couple more points about these topics. On the point of presenting numbers, I would like you to remember that a recent estimate, even if not perfect, is much better than a just a plain number every single time. Okay? So instead of saying our engagement program saved us 2 million, where there is just a number, no methodology, when finance sees it, they view this as an opinion. It invites challenge, it creates skepticism, and at some level undermines everything else you present. What you might say, though, like we said in the last slide or so, that it resulted in in an improvement in engagement of about 8 points. This led to savings about 1.7 million if you use a benchmark replacement number of 1.5 and a 15% attrition reduction. Here, the benefit is you are stating the assumptions and you are identifying the source. Now, it may turn out that the number is actually smaller than what you would like to say, but it is much more reliable, or at least comes across as much more reliable. Now, it is true that every time you state an assumption, that too will invite scrutiny. But that is part of the process. And the best part is you have already helped establish a line around which a point around which the discussion is now centered. So you are already ahead by kind of taking charge of the discussion. The other point that I want to reiterate is if you see a gap, do everything you can not to hide the unfavorable metric. Again, your job is not to present a perfect picture. Your job is to present an accurate and forward-looking picture with a plan, right? Especially when you own the gap with a credible remediation plan and with a timeline identified, that is exponentially more credible than pretending that the gap doesn't exist. It has the added advantage that it tends to position you as a leader who manages reality or is unafraid of reality being different than expectations, and less of a manager who tries to manage appearances. So, anything else? So we have so far talked about identifying the metrics gap, mapping metrics to outcomes through the 3-layer chain, mapping activity metrics to outcomes, applying function-specific metrics, using the right language for your function, benchmarking, using forward-looking indicators, and then building the financial dashboard. So, that brings us to the end of this video, but I want to say a couple of things, right? I don't want to characterize this as fun. Let's be honest, and I know that you'd rather be focusing on things you're good at. And if you had a chance, you'd be better off adding value doing those things instead of dealing with finance. But what I'm trying to convey through these videos is that it's not hard to do hard to negotiate with or manage the IP interaction, it's not as hard as you think. And in fact, the functional leaders who I've seen consistently protect and grow their budgets are not always the ones with the most resources or the most political capital. They tend to be the ones who have learned to do this translation, to translate from the language of operational outcomes to the language of capital allocation. And hopefully you have realized that none of this requires a finance degree. It does require a method, a standardized method applied every quarter, every reporting cycle, not just at annual budget time. Hopefully, with what you have learned, you are now the functional leader who is able to speak the finance team's language and is now the one who does get heard. Okay? So do let me know if you have any questions or comments, and if you need additional help, I'm here and I would love to be able to support you. Do check out the tools available on the Finance Library site too. There is a whole host of them, like I mentioned earlier. So with that, we'll end this video. Thank you for your time.